You're watching Stock Watch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Pierre Verster from Protea Capital Management and Mark Du Toit from Oyster Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much, gents. Of course, we are dealing with panic in the US. We have not seen those markets taking a breather. I think since last week or since late last week, there's a lot of volatility there. Actually, the first question, Mark, let's start off with you. Given that US markets have dropped a bit, is it worth stocking up on a US market ETF now, or should I hang on a bit longer? Are you looking? Firstly, just contextualize this kind of panic that we're seeing in those markets.
Yes, I mean, since the start of the year, we've seen a lot more signals that global growth is going to be slower this year, caused by a lot of tariff noise at the moment, and we're not sure where that all lands. So it's causing a bit of a crisis in confidence, and when businesses can't plan, they're not confident in the outlook, then they tend to hold back on their plans and to wait. Plus, any kind of tariff that the US does implement potentially pushes up inflation, which means less rate cuts. So it really is around a fear that the global growth is going to be slower, and I mean we're even starting to see the probability of a recession ticking up in the US as well, which again is just negative for risk assets.
Yeah, but I don't know how many times the markets have flagged that a recession in the US could be coming, and then it just never comes. JP, you mentioned off air that your stock pick is in the US. So looking at, of course, we're going to get to that at the end of the show, but just looking at what the viewer is asking here, if they should be picking up, just like you, out of the US markets, if this is a good opportunity, and actually why it's a good opportunity, considering that there are all these alarm bells ringing on a recession.
Yes, so Zinati, I'm selectively buying into the US market, selectively. It reminds me about the question, how do you boil a frog? And that is slowly. You don't put a frog into hot water, it will jump out. You put it in cold water and you slowly increase the temperature. So the US markets, having risen so much over the last few years, is a similar case. People have been conditioned that every time the market falls by roughly 5%, don't worry, you just buy some more and it will go back to the way it was. But you get lured in like a frog in the water. Because if you take a step back, I would still say that the US markets are at relatively expensive levels in general. Doesn't mean all shares are expensive in the market, but a lot of shares, probably the majority of shares, are on the expensive side. So yes, you could buy an ETF in the US, but I prefer to do some stock picking and go for those shares which also were sold down, but maybe are more keenly priced or fairly priced rather than the very expensive shares that are still expensive. They're just 5% less expensive.
Yeah, all right. Well, on that, of course, we know that there's been a lot of buying activity in gold. Can you discuss trade-offs between gold ETFs against bonds? Is there a preference? Is there a trick to this, Mark? How do you actually compare those two?
Yeah, well, I mean, they're essentially different asset classes. I mean, you want to hold gold when you think that inflation perhaps is going to be high for a long time, or that you think there's going to be additional risk in the world, like perhaps there's a new war that's going to break out or about to break out. So it is kind of like a very long-term. Some people see it as core to portfolios, others don't. The problem with the gold is there's no return other than price appreciation. And that's what's different to the bond. So the bond pays you a coupon, so you know what the interest return is going to be, and you get better returns from bonds when risks deflate. So if things get less risky for, let's say, for South Africa for the moment, then your bond is actually worth more. So yeah, so different asset classes altogether. I guess given that gold has had such a strong run, so far over the last few years, I'd probably pick bonds over gold for now, but it's a very difficult choice to make.
Yeah, exactly. Yeah, considering that one works well in a less risky environment and the other works really well in a more risky environment. JP, would there be a preference here?
Well, the one asset class that hasn't been mentioned here is equities. And that's an asset class that also in general does better when risk is decreasing.
Yeah.
But if you pick the right shares, even within the increase and decrease in risk and the volatility of an equity share, you're buying into the productive energies of a management team and a company with a product or a service that generate revenues. And that for me that's what I enjoy about investing. So it's not just about looking for asset classes that are uncorrelated in the short term. That does have value, but you can, to a large extent, find almost anything if you look in equities. So I don't spend a lot of time analyzing bonds. I don't spend a lot of time analyzing commodities, including gold. I spend my time analyzing companies and then thinking if I want to buy the equities, and sometimes you get hybrid instruments, preference shares, stuff like that. That is quite interesting. But that's my preference. So yes, you can dabble in bonds, you can dabble in gold, but if you can find shares in companies that are very good quality, that have high returns on capital and a wide moat or competitive advantage managed by a good management team, that for me is the sweet spot.
Well, I thought that Absa was in a sweet spot until today. They, of course, released their results, but I saw that the share ended up down almost 2% today. I don't know if it dragged the rest of the banking sector down. I saw that Nedbank was down almost 4%. There's a question here. I have Absa shares, and I'm not sure to hold on or sell right now while I've made a profit. And quite interesting because there's a consensus that it's surprised to the upside in terms of their earnings, Mark.
Yes, so I'm a happy Absa shareholder, and I was very happy with their results this morning, growing earnings at 10%. Net asset value grew by 11%, which is a really good effort, and they had a fantastic second half to 2024 as the credit losses reduced. I think the only sort of soft part of the result was the outlook statement, unfortunately. So they're a little bit conservative on the outlook statement, sort of guiding towards about a 5% earnings growth for 2025. I think that they are kind of seeing their target a little bit soft so that they want to be able to meet or beat guidance, because in recent times they've missed guidance a couple of times, so they really want to put the record straight now. I guess the other thing to say is also that I mean, we came into this year quite bullish on the South African economic outlook, and with all the global tariff noise, and of course our quite public spat with the US, our government spat with the US, things are looking a little bit less rosy, but we are expecting still real wage growth in South Africa, which will be good for lending, good for people having more money in their pockets, being able to take on a bit more debt and invest into hopefully productive assets. So yeah, I think that largely we are still bullish the South African banks, and I think that Absa's got a lot of things that they can fix and improve on, and they've got a good base to work from. CIB business did very well, the Africa business is doing well. So yeah, I think it's a good base, and hopefully they'll beat the guidance that they put out.
It's quite interesting that they have a softer outlook for their own earnings, but actually on South Africa's 2025 economic growth, they are more on the more optimistic side, forecasting growth of more than 2%. JP, just also looking at the Nedbank share price today, declining almost 4% after a great uptick in the share price when they released their results. Could it maybe be a bit of a comparison between what Absa produced and what Nedbank produced? What was actually the reason here for this downbeat day?
I was asking myself the exact same question, Zanati. So I'm not too sure why today Nedbank took a smack. If you go back longer, let's say over a year, then the Nedbank share has done quite a bit better than Absa shares. And I think of all the four universal banks, these days we must almost say 5 universal banks, because Capitec also has got a significant business banking franchise. But Nedbank shares have done better than the other 3 traditional competitors. So, sometimes you get these daily movements and there's not, you can sort of like make up a reason and it sounds very clever on TV for a bobbing head like myself to give you a reason, but half of the time it might not actually be the correct reason. So I shall
Okay.
rather not give a reason why Nedbank shares were down today because I simply do not know.
All right. Well, thank you very much for your honesty there, JP. Let's go into Sasol. There are two questions on Sasol. The first one is Sasol still good to invest in? I don't know about still good because a lot of you have been saying, no, it is not good. And we've also seen in the share price that things are not good. Mark, just talk to me about that, looking at the viewer that is considering going into Sasol.
Yeah, I mean, Sasol, we've discussed a few times on the show. I mean, they're in a difficult space. So they've got the second operation, which is making good money when the oil price was above 80 and the rand was sort of 19 rand to the dollar, then they're making good cash flow. But they're also having to invest that cash back into the plant, so having to spend a lot on maintenance capex. And once, when you look at what's left after that, there's not too much left over, which they need to service their debt. They've also got the big investment in the US. They've got the US cracker, and they've got a lot of dollar debt. And unfortunately, the chemical prices at this point are very depressed, so also not making great cash flow in America. So for me, I mean, I think I've said it in the past, like I would want to see chemical prices start to move up. I think that would be a real game changer for Sasol because they can pay down their dollar debt with their dollar earnings out of the US. But unfortunately, at the moment, there seems to be an oversupply of chemicals. The Chinese have also built capacity there. And just in the short term, seems like there's no good news for chemical prices. So I'll just sit on the sidelines for now and watch the Sasol share price go up and down.
All right. Now, JP, will Sasol turn around? And the interesting part of that question is, or are they heading downhill like Sibanye? I do understand the downward trend that Sibanye has been in, but there's been this general narrative that as soon as the commodity cycle turns, Sibanye will actually be one of the counters that benefit the most. I don't know about that comparison. What do you make of it?
Yeah, I think it's a valid comparison. Both these companies are very reliant on an underlying commodity. In the case of Sasol, the oil price. In the case of Sibanye, the PGM basket, whether platinum, palladium, or rhodium, a little bit of gold as well, but mostly the PGM metals. And if those underlying commodities bounce hard, the share prices will bounce hard because the companies, both Sasol and Sibanye, respectively, will make good money from the current very low levels of profitability if the underlying commodity increases. So it is a valid comparison. However, I still believe that the probability, we don't know for sure what's going to happen, but the probability for me is still that these companies might not have the best outlook. There's obviously a chance that these underlying commodities will increase and save the day. But if they don't, both these companies have got a bit of a problem. I would say Sasol a bit more so than Sibanye, but Sibanye is not too far behind because they've got debt. And if you're not generating cash, and making positive returns, then your debt is like a ticking time bomb. So Sibanye already needed to issue a convertible bond, for instance. Sasol is also getting closer to that point where the debt is so high they need to think about if they've got sufficient equity. So no, I don't think a long position in either share is something that I want to get involved in. We still have small shorts, as a matter of fact, in both these shares.
So you're not betting on any kind of turnaround on Sasol anytime soon, JP? All right.
No.
Well, something else that investors have their eye on in terms of a turnaround is Renogen. There are two questions. The first one is, why did Renogen rally? Well, it's up 2.5%, and I'm not sure how significant it is considering the downward trend that we had seen prior to this, Mark.
Yeah, I'm not sure. I mean, in Renogen share price, a 2% move is like pretty standard for the day. It seems there's not a lot of liquidity in the stock, and it can go up and down a fair amount on the day. I mean, Renogen's also been through a really difficult patch. They need funding to build the second plant for their helium, and in order to do that, they're going to have to raise money and they're trying to do that in the US. And so, given all the worry about tariffs and the diplomatic difficulty between South Africa and the US, I mean that's also an added risk for Renogen. I really, it would be great if they can get this plant up and running. I mean, I think it's about a 20 billion rand plant that they want to build, and it would be fantastic for South Africa. But it's going to be tough for them to secure that funding, and that's what the market's trying to price in their share price. Added to that, they've also had a fairly public, well, I don't know if you call it a fight with their neighbor who's putting up a solar plant where they would ideally like to put their second plant. So there's that as well. So they've got a lot of problems. They need funding, and I think for me it's very speculative at this point.
Yeah, it's so interesting how everything works, because maybe a year or 2 years ago, investors were betting on the Renogen raising money in the US, and that was actually a very, very big driver of buying activity. But now, actually, it's quite an interesting point that you make, that might not be so easy now. There is a viewer that says, I'm in Renogen, got in at 15 Rand 50. Please share your thoughts on Renogen, and I'm thinking of averaging down to about 6 Rand. Yes or no, JP?
For me, it's a no. So I've never had a short position in Renogen, but I wish I had. It was just too small. I've got a cutoff in terms of how large a company's our liquidity is before I would consider shorting it. And Renogen was below that threshold. But I mean, when all this nonsense started, you compared what the engineering report said was their reserves versus then what effectively they started to pump out of the ground. There were some questions that one could ask, and it was a good short. I think still there's some questions that can be asked. It is relatively illiquid. There's a big chunk of the shelving and activity that happens in Australia, where it also has a listing. So that complicates matters as well. So no, for me, I would then just pass. I would not get involved. And I wish I had been involved on the short side previously.
Yeah, all right. Well, let's get into banking again, but not in the 5 big banks that we were talking about previously. We're looking at Investec. What's your term view on Investec? And I'm actually looking at that chart, and there has been a downward trend since last month, quite a sharp one, actually, in March. Mark, your thoughts?
Yeah, we like Investec as a business. We own shares in Investec. We think that their prospects are quite good. I like that they've actually done a great job in simplifying the business, refocusing on banking and less on doing kind of deals. I think the South African business, they've got a really great private bank. They're looking to double the number of clients. They're looking to bring in IT professionals. Previously, it was more accounting and medical professionals in the business, or as a customer base. And I think that that's quite a nice strategy. Also looking to do a bit more in business banking, leveraging their current customer base. And then in the UK, they've also got a nice business. It's got a smaller client base, but higher net wealth individuals. I think the UK macro is probably weighing a bit on its share price, but I think that the UK business it's pretty solid and will continue to grow. Plus, they've got their stake in Rathbones now, and Rathbones' numbers were quite good. So yeah, I like Investec, and I'm looking forward to them just to carry on delivering and doing what they say they're going to do. And I think over time, the share price will re-rate in accordance with that.
Yeah, quite interesting, because I'm actually looking at a longer term view of that chart, and it's actually been under pressure since November last year. JP, your thoughts on Investec?
Yeah, I think it's solid. I'm keeping my eye on the dividend tax issue, the cum-ex dividend matter that a lot of banks are involved with. But there have been a few settlements. At least it looks like that liability could be relatively contained. There were some larger concerns previously. And then if you take a wider perspective, because we manage funds that invest globally, I like other banks in Europe and the UK even more. So it's not that I don't like Investec, it's just that one's opportunity set, if you look outside just South Africa, becomes so big that sometimes you find opportunities you like even more. So I prefer to, and we have held a few other European banks, and Investec is decent, but it's not my first choice bank. There's a few others that I prefer.
Right. Just checking to see how much time I have before, all right, 4 minutes. Okay, let me ask about Pepkor. Mark, I do know that Pepkor is your stock pick for today. So, JP, the floor is yours at current levels. Could this be a good entry point?
Whoa. So Pepkor, together with a bunch of other domestic-focused shares, have come down quite a bit over the last 3 or 4 months. And for me, it got a little bit too expensive late last year, and it's trading closer to fair value, in my opinion. I like the fact that they're exposed to the lower end of the market, which has seen a relief in pressure from load shedding and high petrol prices and interest rates and all that. Obviously, beginning of the year is always back to school time, where Pepkor has a large market share. So I'm sure they were very busy. And then as they expand in Brazil, I think that that's an exciting extra leg for the very long term for the Pepkor business case. So I wouldn't have bought it a few months ago, and we didn't own it then. I would start looking at it at the current levels.
I think Pepkor should buy that advert that we used to have from CNA, back to school, back to reality. Well, Mark, you are picking up Pepkor at these levels, your stock pick.
Yes. Yes, so we like Pepkor at these levels. We've seen the South African retail stock sell off quite heavily at the start of this year. I think last year they got very excited for the two-pot withdrawals, and there was some additional earnings from that, but maybe a little bit of a disappointment in the end. And then I think, going into our budget this year with the proposed 2% VAT hike, which we'll hear tomorrow if it's been reduced, and we think it will be lower than that. I think the South African retail stocks came off. So we like Pepkor as a business. We like the management team. They do have longer-term growth prospects in Brazil. I mean, if they get that right, then the stock can really be worth a lot more. But in the medium term, we think earnings grow above double digits. You get a reasonable dividend, 2.5%. So you're looking at about a 15% plus return per year, and plus you've got the added longer-term growth story if it works out in Brazil. So we like it at these levels, and we think you'll get a good return in the medium term.
All right. JP, you are bargain hunting in the US. What exactly are you looking at?
Yes, I'm looking at a stock that has fallen 25% just in the last 2 weeks or so, after it went up very sharply, and that's Robinhood, taking from the rich and giving to the poor, or in this case, allowing the man in the street, anyone, to trade stocks at zero commission and be involved in the market, and not just the stock market, also the crypto market. And while I'm not a fan of crypto, I won't judge those other people who are involved in crypto. And I would gladly buy shares and own a stake in a market operator that offers the platform and makes money from other people trading cryptos. I have no problem with that.
Okay.
So if you look at the long-term prospects of Robinhood, while in the short term, the market's being down quite a bit is not good for their activity, because their clients will probably have less money and will trade less. Over the long term, I think structurally it's a business that's in a good position. They had an investor day a couple of months ago, and it was a very bullish story. And I was waiting for an entry point, and now that the shares are 25% down, I think the entry point is here. And I think over time, people will increasingly self-direct their investments using platforms, cell phone platforms, online platforms. And Robinhood is the leader in the US and increasingly expanding from there into other countries as well. So Robinhood is my stock pick tonight.
All right. Well, thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Pierre Verster from Protea Capital Management and Mark Du Toit from Oyster Investments. Up next, the close. Stay watching.